to talk about financing for a small business, or what a lender really wants to know. But we're going to start with some myths. The first one being, you can get a grant to start your business. That is 99.9% of myth. There are a few, very, very, very few grants available to start a business. Most grants are available to do something within a business once it's established, rather than to start it. There actually is one that I know about and some of our clients have gotten. It's a matching grant. And that is very valuable to have and to know about. And we'll talk about it later. But most of the grants are there to help do something within a business that's already established, up and running. The second point, the government will give you money to start your business. Probably not. Probably not. The government has a lot of programs that are guaranteed for people who are in business or want to start a business. But they're guaranteeing those funds to a lender, the bank on the corner. So it's not really a direct loan or direct money from the government to start a business. And then you won't need any money to start a business. I can't tell you how many people I've talked to over the years that say, well, I don't need a loan, I have enough money. And 6 to 8 months later, they're back saying, I need some more money. It's expensive to start a business. So we need to think about that, and we need to be sure that we have funds available up front. Now, as the business grows, we may need more money. So as it grows, we want to look at how we can secure financing, and the best thing there is to find out what that lender wants to know before you go talk to them. So the first key here is that we know businesses are going to need money. They need money to get started, and they need money to operate once they are in business. So where do we get the money? The first place to look is in your own pocket. If you have funds to start the business that you can invest. I've never seen a 100% business loan, and I've been doing this for 17 years now. It's not out there. It's not like zero down for a house or zero down financing for a car. You have to have money in the game, or as most of the lenders call it, you have to have skin in the game. You have to have funds personally to invest. So where do those funds come from? Generally, they're going to come from your own pocket. They may come from family and friends. They may come from banks, vendors or suppliers. Actually can help. Credit cards, with a lot of caveats, leasing, and maybe your own customers. If you're in a service business, it's not uncommon to ask customers to pay some up front. Now, that's not going to work for a child care center to say, would you help me fund my business startup, usually. But those are the main sources for funds. There are top 10 questions, I think, that lenders want to know when you go in to ask about starting a business. How much money do you want? Think about it. If you had someone come to you and say, I want to borrow $150,000, what do you want to know from them? How much do you want exactly, and what you're going to do with it? That's the important question to the lender. How will you use it? Are you using this just to pay yourself? I don't know if anybody watches Shark Tank or not, but it is a great show featuring entrepreneurs who are trying to get money from investors. And those entrepreneurs make some fatal mistakes. One about, I guess 2 weeks ago, actually came in and said, we want $150,000 so we can pay ourselves. Do you think they got the money? No. That's not what the lender's looking for. The lender is looking for things that you're going to spend that money on to actually grow the business or establish the business, not just put it in your pocket so that you can work in the business. So that's really important, how you're going to use it. The next question is how and when you can repay it. Lenders generally are in business to make money. They're not charities to the greatest extent. If you find a charity, you may have an opportunity to find a grant too. But generally, they're not charities. They're trying to make money. So they want to know what you're going to do to earn the money to pay them back. How are they going to get their investment back with interest? So it's really important that you're able to tell them that. How will the loan, grant, or investment affect your financial condition? Well, if I am going to get a small loan and it will help me for 2 months, that's okay. But then what am I going to do after that? And the lender's going to say, no, you're not looking for enough money. This won't keep you going. This won't help the business. The business will still fail at the end of 2 months, and I'm out. My money's gone, and you have no way to repay me. What is the collateral that you'll pledge to the lender? How much do you have, equipment, buildings, whatever, of value that that lender wants? Amazingly, there are some things that lenders don't want. They probably don't want your car as collateral. Why not? It's a depreciating item. The more miles you have on it, the less it's worth. So if that's collateral on a 10-year loan, that car's not going to be worth much. So they don't want your car. They might want, they do want CDs. If you have a CD, you get 100% collateral value. That's in the bank. That's controllable. It's not depreciating, and it will be tied up tight with strings so that you can't go cash it without them knowing about it. They don't like inventory as a rule, depending on the inventory, but generally they don't like that because inventory frequently, think about a plant nursery. What happens to the inventory? Part of the inventory for child care would be food. What happens to it? It's not going to be there. So one of the things that you have to think about is the long-term value of any collateral. Finally, lenders want to see that you have projections of future cost and future income. And those projections, if they're realistic, help them to understand whether or not you have the potential to pay them back. So they look at those projections and say, are these realistic? Are you really going to have 100% of the children enrolled in this program every single day? Are you really going to be at 100% enrollment every day of every year? Probably not. So those would be considered to be unrealistic expectations, and in that case, the lenders are probably going to turn down the loan proposal. If your projections fall short, what will happen? If you don't have the money to pay them back, what's going to happen? They still want their money back. And how are you going to pay them back? Therefore, if there's a second source of income somewhere, that's a real plus. If you have highly secured and long-term value items pledged as collateral, then they're a little more comfortable with those projections. But they still want projections that are going to be realistic based on the market, based on what's going on in that particular industry. So where are we with childcare? What is the industry outlook right now with childcare? Do we have every childcare in Grayson County has a waiting list? Are we there now? We were at one time pretty much. Is it still that way? No? They're struggling. Why? Because of the economy. So there's a lot that will affect how realistic those projections are. When we look at demand within an industry, that's where we start to determine projections. What is the demand? Are we in a stable industry? Are we in a growth industry? Or are we in a declining industry? And how do we decide? There are a lot of resources out there and expensive resources that we have available in our office that we can help our clients with. And one of the things we do is run industry information to show us the status. Is that industry a very stable industry over time? Is that industry growing rapidly? Because all of those things impact how well you can project the future cost and income of the business. If business gets really bad, how long can you stay alive? How long can you keep the doors open? It's a critical question, and it's one that every business owner needs to answer and be prepared to seek solutions for. How bad can business get and I can still keep my doors open? And then finally, how are you going to manage the risk? There are risks in every industry and every business. How do you manage those? How do you minimize the risk where you can, and how do you cope with those that you really can't minimize? In a child care center, what's going to happen? Susie is going to trip and fall. It's going to happen sooner or later. or Bobby's going to push her and she's going to fall. What happens? That's a risk. That is a part of inherent risk in doing business, in owning a child care center. So what do? You try to minimize it. You try to make safe surfaces. You try to have adequate supervision. You try to teach children how to behave. You try to minimize the risk. And if all else fails, you're going to have good insurance, we hope, good liability insurance. So those are ways that you can minimize that risk. And that makes a lender more comfortable making a loan to a business because they know that they can handle those risks that might otherwise really damage the future of the business. Now, we can answer all the questions, and just as I have, and talk to the lender and say this is what happens, but they're not going to take your word for it. They're not going to take my word for it. They want documentation. So how do we do it? One of the things that we initially have to think about is the type of financing we're looking for. We have debt financing and we have owner equity. Owner equity is the cash I put into the business that I pretty much control. Debt financing is where I have to go to seek outside financing or outside funding for my business. If we are looking at outside funding, then all of these questions are doubled. We need to answer all of these questions for the equity we're investing, but we also need to be sure that we do a very thorough job of answering them for any lender. So where do we start? The first place we start is with ability to repay. Your cash flow, how much money comes into the business and how much money goes out of the business. That is a critical factor for every business. Businesses can grow so fast that they go bankrupt, which sounds unusual, but it can happen because they have expenses with the growth. So if suddenly I go from 15% utilization in my child care center and suddenly I have 100%, what's going to happen? I need more of everything. I need more of everything. So I have expenses in bringing in more staff. I have expenses bringing in more food. I have expenses bringing in more equipment, everything. And I put all of that into the business and suddenly, what? I don't have enough money to pay all those bills at one time and keep it going. So that ability to repay and that cash flow projection is absolutely critical when you start looking for a loan. So what do we want to do? We want to project our income and our expenses. That's where we want to go with it. One of the first things when you actually walk into the lender, he's going to say, let's talk about your credit history. And you need to know exactly what it says. What does your credit report say? Because a very high percentage of them have incorrect information in them. So what do? One of the things that you want to do is to get a copy of your credit history first. Get that credit report, look over it, and if there's a problem, start trying to correct it right then before you go talk to the lender. Because it will take a while to do it. You have to be extremely persistent and you really have to be patient because it takes a long time. If you do not or are not able to correct what is on the credit report, credit reporting agencies have to include your side of the story in your file. And that takes some time as well. So it isn't a quick process. That's not a last minute thing. Get a copy up front and go over it carefully to be sure it's correct. Your investment. Most lenders want to see 20 to 50% of the cost of a startup business or expansion in a business coming from the business owner. That's because you're going to be more concerned about the success of the business if your money is at risk as well as their money. The 20 to 50% is negotiable to some extent, depending on the risk in the business. If it's a high-risk business, construction is the highest risk. If it's a high-risk business, then you're looking at 50%. If you want to start a restaurant, you're going to pay half of the money to get started because the failure rate is so high in that industry. Collateral, we've talked about that. Discuss it. Find out what your lender thinks is good collateral. Some lenders have a lot of raw land, undeveloped land. They don't want any more. That has nothing to do with the fact that another lender might take it. It just is what is in their portfolio already. So talk to them, find out. What will they accept as collateral? I've already said CDs are their favorite thing in the world. Cash value, that's what they want in collateral, because they'll discount it. If I use the example of the car, it has declining value. That's how the way they discount it. They may discount up to 85% the value of that collateral, because what they're looking at, if you want to think of it this way, are garage sale prices. If they take your collateral, they don't want it, number one. They want to get rid of it, and they want whatever cash they can get out of it. So they're not going to spend a lot of time looking for the best price. They are going to sell it as soon as they can, and they will take less. One of the critical factors early on is to think about management experience. Management experience is just very, very important to the lender. If you're an experienced business owner, if you have had a long period of time when you've worked in this business or managed a similar business, then they are much more likely to make the loan, because they know that you are aware of the pitfalls within any business so that you're better equipped to deal with it. So when you're working on the information to take to the lender, be very sure that you have that management experience, a resume, a very thorough resume available. And then you have to sell your idea. The first thing when you walk in the door with a lender, he wants to know what kind of business are you going to start, or expand, or keep going. Keep going is touchy. They don't really like to give you a loan to keep going, because to them that indicates management is lacking somewhere or it's not a viable business. But if you're going to expand, if our neighborhood is growing like crazy and I have a waiting list and I need to expand, that's a good sign. They're much more eager to make that kind of loan. What's the market for the business? We do this by looking at demographics. You should know your target customer. Who is your customer? How old are they? Where do they live? How much money do they make? And that is pretty easy to figure out usually. If you have one-on-one contact with your customers, you know who they are, and you know which of those demographic categories they fit into. The market is looking at a geographic area and figuring out how many of those target customers live in that area. If you're in an area that is highly mobile, a lot of people move in and out, it's a lot harder to figure that out. Okay, what's your competition? I have people all the time say, well, I don't have any. That's not true with childcare. We have a lot of competition. So what we want to do is analyze the competition. Every very successful small business is a niche market. They serve a small window of the customers because they are a small business. So what's your competition? Okay, the competition would be, number one, other child care centers, other child care facilities. What else? Because there is more competition. It's grandma. It's mother doesn't work. It's whatever those other options are that a person would have rather than going to your business. What is the location of the business? This is really important to think about. The location, and you've heard the old adage, the important thing in business is location, location, location. To a large extent, that is true. So is your business in a location? For example, is it in an area that would be considered a safe area? Because that's going to affect who's going to use the business. Are you in an area that's easily accessible? Maybe or maybe not. But the location, because of the demographics and the area served, is a vital question. What kind of equipment do you need? That's pretty clear for child care centers. The state helps with that question and helps identify the different types of equipment that not only would be needed but required. So that one is pretty easy when you're talking about a licensed type of business where there are specific requirements. Finally, who owns the business? What are their qualifications? What is their experience? What do they know about running a business? That, again, is one of the critical questions. How much money do you want and need, and how are you going to repay it? What about the numbers? Well, there are two sets of numbers we need in developing that information to take to the lender. We need to develop a worksheet showing how many dollars we need and how that money is going to be used. For example, if I need to buy equipment, how many tables and chairs do I need, and how much will that cost me? If I need to hire additional staff, what do I do there? How do I do that? How do I figure that out? Usually we look at the salary that we're paying, salary or wages, and then we look at fringe benefits. Usually 10, 12, 15%, depending on what's involved with the fringe that would be offered from the business. So we look at those two costs first, because that's probably 80, maybe 90% of the cost of operating a labor-intensive business, which childcare is. So when you look at the personnel cost, and then you start looking at the other areas where funds are going to be needed, it's really critical to do a very good estimate, because you don't have much room. If your personnel costs are going to be 80% or above, you don't have much room in there for other costs. So it's very important that you think carefully about it. And again, when you have staffing costs that high, there's no way to recover that money. Once it's gone, it's gone. Now, in some cases, if you have too much furniture, you can sell it. If you have too much of some other things, you can get rid of it to generate some cash flow. But with staffing and personnel costs, that's gone. There's no way to recover any of it. So we need a worksheet. We need to know exactly, as close as we can get it, what that's going to cost us to hire the staff that we need and to pay the fringe benefits as well. The second set would be a spreadsheet. The spreadsheet is much scary, looks scarier than it is really. The spreadsheet really is going to be looking, it's just standard, lots of numbers, but it's going to be looking at cash into the business and cash spent by the business. And we obviously have to have a balance in there. That's what the lender wants to know. The numbers are the critical factor in there. Do you see that the business will or can generate enough money to pay all of the cost of operating that business? When we do that, we will learn whether we have a charity or we have a business. Because if we do not have cash flow and if there is no profit to the business at all, assuming it's a for-profit business, then we're not operating in a way that that business can continue for year after year after year. It can't be sustained. We talk about sustainable businesses. That one would not be a sustainable business. Charities, not-for-profits, also have to look at creating a spreadsheet. They have to look at cash in, cash out, because again, if they're sending more out the door than they're bringing in, they aren't sustainable either, even though they are a charity. So once we have those numbers, those two sets of numbers, what do we do with them? We create a balance sheet. And a balance sheet simply shows what the business owns and what the business owes. Those are the two critical factors on a balance sheet. A pro forma balance sheet is an estimate. That would be for a startup business, but generally we're going to be dealing with an established business in a service industry before you're looking for a loan. So that balance sheet will tell your lender exactly what the business already has, how much has been invested, and how much is going to be needed. So those are the two questions with the balance sheet. The other is that cash flow statement. Total cash coming into the business and total cash going out. It is simple math, but it takes time to do it. And most people are intimidated about it. You can have a CPA do it. You can have your bookkeeper help with it. There are a lot of ways to get help with it. We help our clients do this all the time. But what you want to do with approaching a lender is to have at least 1 year of projected cash flow, what you think is going to happen in the future, showing how you're going to use the money that you are asking for. So if I'm asking for $100,000, How am I going to use that $100,000 in the business? If I say I'm going to hire 3 more people for my staff, does my cash flow projection reflect that? Does it show that I'm increasing my staff? Those are the questions, again, that raise the red flags. If the numbers don't match what you're saying, then most lenders will just say, thank you, we can't help you at this time, because they know you haven't really done your homework. That's a simple question. So when we're looking at the actual documents that we need to put together to take to a lender, what do we need? The first thing is to show the name, the legal name of the business, and that's either assumed name certificate, articles of incorporation, or it could be an LLC, that type of information. A copy of that, because it shows that you are a business. And lenders are a little leery sometimes of people who come in and say, well, I'm already in business. They want it validated, because they hear that a lot when in fact those people really aren't in business. A credit report, second thing on the list, and that's what we've already talked about. Be sure it's correct, because that is something they're going to spend a lot of time on. Generally, the higher your credit report, if all the other information is positive, the better your chance of getting a loan. But there are some lenders out there who will make loans if the credit is low, around 590, something like that, 580. It's going to cost more though, so take care of your credit. More risk that they see in your credit report, the higher the interest rate if you can get the money. The sources and the amount of the owner injection. And we've talked about this. This is the owner equity, the money the business owner's putting in the business. The source is important. If it's borrowed money, they need to know it. If grandmother said she'd give me money to start my business, that money has to be under your control. It has to be in your name, not grandmother's. So that has to be done before you go to the bank. And the amounts, obviously, they want to know the amount of the thing. The legal description of any real estate you're buying. So if you're buying property or you're buying a property with a building, they want to know what the legal description is, and that's on your deed. If you are buying it from another source, if it's listed with a realtor, they're going to have that information. Otherwise, the owner is. An itemized list of equipment. And why would they want that? Because that becomes collateral in most cases. Tax appraisal on the real estate. Is it really worth what you're telling me it's worth? If you tell me you need $100,000 to buy this land with this great building on it, is it really worth $100,000? In what, the last 5 years probably? Maybe more than that. You could generally buy land and buildings, housing in this area for less than the appraised value, because there were a lot of people trying to sell houses. Right now in our area, realtors are calling people and saying, would you like to sell your house? I had an example of this just a few weeks ago, because a realtor had, I think, 2 houses listed on one street. She had 9 offers on one. It sold well above the asking price because they were in a bidding war. And she just called every homeowner on both sides of that street and said, would you like to sell your house? Because both the houses she listed sold in like a week. So right now, it's likely that sometimes the sale price is going to be above the appraised value, and that can create problems for the lenders. Okay, so we want that tax appraisal. We want a personal financial statement. Why do we want that? You're borrowing money for your business. The personal financial statement is going to show how well you manage your personal income. And why does that matter? Because the lender thinks if you can't manage your personal funds, you can't manage business funds. And they're probably right. Personal income and expense analysis for owners. They want to know how much it costs you to live personally, because they know if it comes to buying food for yourself and your family or paying the loan back, you're going to buy the food. They want to know about income tax. Pardon me. Have you paid your income tax? And they want that document. They want to see a business plan. That's important because what that does is tell them that you have looked into the future and you have done your homework about your industry, the finances, the operating cost, everything. And finally, they want those cash flow projections. They want that on paper. They want it documented. If I say I think my enrollment will continue to grow at 5% a year or 10% a year, why do I think that? Because it has for the last 5 years, and nothing has basically changed in our community. If I think it is not going to grow, then what do? I probably don't need to expand, so I don't need the loan, and that's what the lender's going to say. Okay, finally, any kind of proposed contracts, leases, employee contracts particularly, are very important to include because that locks you into future cost. And that's something that your lender is going to really, really want to know about. I have several guides actually that I think are helpful. We have one on marketing for the small business. That helps you when you're looking at investigating the demographics, investigating the best way to grow your business. It really helps you to know how to plan that marketing for the future. I also have a resource guide on money, where and how to get it. This looks at all the different sources of funding that might be available for business. We have a lot of different sources in our area. We have many commercial lenders, banks. We have a lot of not-for-profit lenders, not necessarily in our immediate area, but that do serve our area. And that's very important to know about those because they generally will talk to people whose loan proposal has sort of dropped through the gaps with commercial lending for whatever reason. It may be the type of business it is. It may be something, the lower credit report. It may be any number of things, but they are, look at them as specialty lenders. They try to fill a gap in there. And finally, I have a guide on how to test your ideas. If I think I need to expand, how do I know I need to expand? How do I determine whether it will be cost effective to expand? If I'm 100% now and I think, oh gee, I need to expand, is it going to be cost effective? Am I still going to have a profitable business after I expand? Because I'll probably have more debt. So there are very serious things we need to look at in making that initial decision to even seek funding from a lender. If there are any number of questions that you may have related to seeking any kind of finance, it's very, very important to be organized. It's very important to be totally honest and straightforward with the lender. If there's an issue, if there's a problem you anticipate with a business, tell them about it. It doesn't mean that you won't get the loan. Sometimes it means this person has really done their homework. They really know what they're doing. They're really being honest about it, and they found a solution for it. So many times you will be able to get the financing that you need in that way. Anybody have any questions? I want to tell you about some resources that might be out there. The Small Business Development Centers serve the entire state of Texas. We're located throughout Texas. The one serving Cook County is located at North Central Texas College, and our SBDC is located here at Grayson College. One of the things that we do is help people who come in the door and say, I have an idea. I think I want to start a business. So we help them. We help them with exactly what I've talked about. Testing that idea. How do you know that this is a good fit for you? So we help you to test the idea, to find out if it's a viable business. I had a client early on who came in and said, I want to start a skating rink. And I thought, okay. So we looked at financial projections because that's the place to start, to figure out whether or not this is a viable business. And I looked at the projections he had and I thought, I'm in the wrong business. I should own a skating rink. Then we analyzed the numbers. And actually, when we looked at the numbers, every man, woman, and child in Grayson County would have had to skate at least once a week at his center to earn that kind of money. So were they realistic? We talked about that. Not even close. Not even close. So test the idea. Look at the population. How many potential customers do you have? If you come through the door and you say, everybody's my customer, I assume your name is Walmart. Because no, not everybody is your customer. We have to determine who the customer is. That's one of the ways we test the market. If you come in the door and you say, I don't have any competition, then my next question is, why not? If it's a needed service, if it's a needed product, why don't you have any competition? So unless you have a patent, secret to patent somewhere, I assume you've not done your homework. So those are simple ways that we can test it. Next, we help people look for where's the money. We work with many, many, many lenders. We try to keep up with different sources because it's like putting a jigsaw puzzle together. We have to make all the pieces fit. The type of business, the ownership, the credit history, the type of loan, all of these things have to fit together for a loan to be approved, and that's not always easy to do. And finally, marketing. It's not the field of dreams. The field of dreams, remember, if I build it, they will come. No, your friends and family will come first because they're nice to you and they like you. But we have to market the business, and it's sometimes hard to do. How do you market your business? Many entrepreneurs get so busy running the business that they forget to market the business. And you must market. People have to know you're there. Marketing is not the same as advertising. Close related, but it's a little different. And you have to do it. It isn't an option. Even if you're the only game in town, you have to tell people where you are. So it's really important. And I think those three, that's why I brought the three references. Those are three critical factors that everyone seeking funding for a business need to address. If you need more assistance, you can contact a small business development center that serves your area. We all work by appointment. There is absolutely no fee at all for our assistance, our one-on-one training. We have a lot of resources, and we have people on staff who are certified business development specialists who can help you. So that's one of the things I want you to take away. You're not in this alone. I've gone over a long list of things that can look intimidating and complicated, but you'll have help. So that's one of the things. Please remember that there is help out there. And if you have questions or you want more information, you can contact our office and we'll be glad to help you. Sometimes our answer is you're not really ready to start a business. But if you are ready to start a business, then we are more than happy to help you with the project. Thank you.